Our next guest is looking ahead to tech earnings. His firm owns several Mag 7s, including Apple, Intelligent Alpha, and Deepwater Asset Management's Doug Clinton joins us now. It's good to see you again.
You too, Scott.
This move today is interesting from Apple, but I still feel like expectations are so muted going into this earnings season. What do you see?
I mean, as it pertains to Apple specifically, I think they've done a great job of keeping the bar super low for this earnings and really earnings until mid next year, because the question still remains, what will Apple ultimately do with AI? I think the iPhone 17 has proven to be probably a better seller than investors had expected when they launched the device last month, but expectations are low, and I think that as we get closer to kind of June next year, WWDC, that's when we'll start to talk more about what will Apple do for its next kind of era in AI, and will it fix Siri? That's where I think the most optionality stands in the stock. But as for the quarter, I think they're in good shape, and our AI models like it too at Intelligent Alpha.
Speaking of low expectations, you say CapEx expectations are too low from both Google and Amazon, which is an amazing thing to say considering the size of the numbers we're already talking about.
I mean, you look at the street numbers for CapEx for those two, Scott. Google, it's about 12% expected growth for next year's CapEx. Amazon's even lower. It's high single digits. It's almost unbelievable. You know, how could analysts sort of expect this? But I think the reality is if you look kind of more at Meta, that's probably a better benchmark, and they're going to be growing kind of strong double digits, probably something like 30 to 40%. And I think you'll see Google and Amazon both. It might not happen this call. They might sort of just indicate, right, that they're going to continue to spend in this CapEx boom. But certainly as we get into Q4 earnings and projections for next year, I think those numbers need to go up significantly. And that's good for companies like NVIDIA and TSM, both of which we also own.
Yeah, and I know they're among your favorite AI plays as well, as is Microsoft. What's interesting is First Solar is as well, correct? Which you call your under-the-radar play. Why?
You know, it's funny, we got this sort of AI bid, this story for Caterpillar over the last month as it pertains to them providing heavy equipment and some power sources for AI. I think First Solar, and maybe solar in general, has sort of been just thrown out entirely. You know, I think a lot of the excitement around energy production, maybe as a era for AI, has been around nuclear, not solar. And I think solar is inevitable as part of the solution to addressing how do we fix this problem where we don't have enough power to power all these data centers that we're building. So First Solar, it's an American company. They build some of their panels in America, and I think that's very important in this environment and with this administration. And our models have loved First Solar almost all year. Trades very low double-digit EPS, and so it feels like kind of a cheap play on AI, as hard as that is to believe.
Would you stay with, I know you don't, it doesn't look to me from your at least your top holdings that you're very exposed to some of these other power names for AI, whether it's Vistra or Eaton, you know, GE Vernova. I don't know if you own them or not, just not in enough scale to get to the top holdings. Do you think that trade continues to work, or is it ahead of itself?
We have owned some of those names, particularly Vistra and GE Vernova in the past. We don't right now. And the concern I have is, you know, everybody's talking about AI bubble, kind of where are we? Are we near the top? For what it's worth, I think we're probably in 1997 in the AI trade right now. But I think there are components of the trade and things that are kind of on the periphery, particularly around nuclear and some of the energy plays, and then also quantum. That feels more like we're in 1999. And so the energy stuff, as important as it is and as topical as it is kind of the bottleneck to some of these data center build-outs that we have right now. I do think a lot of that seems to be priced in the stocks, and I would rather own the hardware and the software players than energy right now.